Investing wisely in Trump's current economy. When navigating the investment landscape during Trump's presidency, it's essential to recognize the policies and economic priorities shaping the market. Trump's administration emphasized tax cuts, deregulation, and a focus on domestic growth, which had significant effects on specific industries and investment strategies. 1. Focus on thriving sectors. Key industries that experienced growth under Trump's policies included energy, manufacturing, and technology. For example, 1. Energy. The administration prioritized fossil fuels and energy independence, benefiting oil, gas, and pipeline companies. 2. Infrastructure. With plans to boost infrastructure spending, related stocks and ETFs gained traction. 3. Defense and aerospace. Increased defense budgets made this sector a consistent performer for investors. 2. Tax-friendly investments. The Tax Cuts and Jobs Act created a favorable environment for businesses, with reduced corporate taxes leading to higher profits and potential stock price growth. Investors could capitalize on this by targeting companies with strong earnings growth. 3. Watch for trade policies. Trump's trade policies, including tariffs and renegotiated trade deals like the USMCA, had varying impacts. While they boosted domestic manufacturing, they created uncertainties for companies dependent on global supply chains. Investing in businesses less reliant on international trade helped mitigate risks. 4. Diversification and risk management. Although some sectors surged, the economy also faced volatility from trade wars, geopolitical tensions, and unpredictable policy shifts. Diversifying your portfolio across asset classes and industries remained a smart strategy to hedge against these uncertainties. 5. Stay informed and flexible. Markets during Trump's economy often reacted quickly to policy announcements, tweets, or geopolitical events. Staying updated on economic trends and maintaining a flexible approach allowed investors to seize opportunities or adjust strategies as needed. 6. The role of real estate investments during Trump's administration. Real estate investments gained significant appeal due to a combination of tax advantages and deregulation efforts. The Tax Cuts and Jobs Act offered benefits such as increased depreciation opportunities for property owners, making real estate, especially in sectors like commercial properties or multifamily housing, a lucrative option. Additionally, Trump's focus on economic growth indirectly supported real estate development in urban and industrial areas. Investors could also explore REITs, real estate investment trusts, which allowed exposure to real estate markets without directly owning property. These provided stable dividends and benefited from lower corporate taxes, making them an attractive choice for income-focused investors. 7. Small businesses and opportunity zones. One of the standout initiatives was the Opportunity Zone program, which encouraged investments in underdeveloped areas by offering significant tax benefits. This program provided a dual advantage. It stimulated economic growth in these regions while giving investors a chance to defer or eliminate capital gains taxes. Small businesses also benefited from reduced regulations and tax incentives, offering promising opportunities for venture capitalists and angel investors. Identifying promising startups aligned with Trump's pro-business policies could yield high returns. 8. Keep an eye on interest rates. The Federal Reserve's monetary policies during Trump's term were another critical factor. The economy saw periods of both rising and falling interest rates, depending on growth and inflation trends. Low interest rates supported sectors like real estate, technology, and consumer discretionary spending. On the other hand, rate hikes often affected bond prices negatively while benefiting financial stocks, like banks and insurance companies. Investors who tracked these trends could adjust their portfolios to optimize returns, such as focusing on growth stocks during periods of low rates or pivoting to income-generating assets during rate hikes. 9. Trade war and its impact on global markets. Trump's trade war with China and other nations created waves across global markets. This had a ripple effect, particularly for commodities, manufacturing, and tech sectors. Companies with heavy reliance on Chinese imports or exports faced challenges, while those focusing on domestic production often thrived. Investors looking to capitalize on these dynamics needed to focus on 1. Domestic manufacturing leaders. Businesses less reliant on overseas suppliers. 2. Emerging markets. While some markets suffered due to tariffs, others like Vietnam and Mexico gained traction as alternative manufacturing hubs. 10. Energy independence. As a game-changer, energy independence was a cornerstone of Trump's economic vision. By reducing reliance on foreign oil and boosting domestic production, energy companies saw steady growth, particularly in oil, natural gas, and renewable energy projects. This was an opportune time for investors to look into companies dominating the U.S. energy market, particularly those involved in exploration, production, or pipeline infrastructure. 11. Technology and innovation. Despite occasional tensions with tech giants, the sector flourished due to innovation in AI, cloud computing, and 5G technologies. Investing in large-cap tech companies, as well as startups pioneering next-gen solutions, remained a sound strategy. Additionally, e-commerce and remote work tools thrived during times of policy-driven economic shifts and the COVID-19 pandemic, which overlapped with Trump's term. 12. Long-term strategies. Amid uncertainty. While Trump's policies created numerous growth opportunities, they also introduced market volatility. This highlighted the importance of long-term investment strategies, such as dollar-cost averaging, reinvesting dividends, and focusing on companies with strong fundamentals. 13. The importance of index funds and ETFs. For those seeking diversified exposure to Trump's economy, index funds and ETFs were a safe bet. Funds that tracked the S&P 500, Dow Jones, or Nasdaq performed well, reflecting overall economic growth. Additionally, sector-specific ETFs, such as those focused on energy, financials, or industrials, allowed investors to target key areas of growth. 14. Stay cautious about speculation. While some sectors soared, speculative investments could lead to potential pitfalls. Sudden policy changes, trade disputes, or unforeseen global events, like the pandemic, underscored the importance of balancing high-risk investments with stable, income-generating assets like bonds, dividend stocks, or gold. 15. Lessons for the future. Trump's economic policies highlighted the importance of understanding how government priorities influence markets. The focus on tax reforms, deregulation, and domestic production provided a clear roadmap for investors. Moving forward, applying these lessons, adapting to policy shifts, staying informed, and diversifying, will remain essential for investing wisely in any political or economic environment. By leveraging these strategies and understanding the broader implications of Trump's policies, investors could maximize opportunities while minimizing risks, ensuring steady growth in a dynamic and often unpredictable economic landscape. 1. Final boost. 2. Remember, every like and subscribe helps this community grow stronger. Together, we can make financial freedom a reality for everyone who's ready to take action. Thanks for watching, and I'll see you in the next video.